retirees seeking market exposure with a built-in safety net find buffered ETFs appealing. They aren't a magic solution, but rather a risk management tool. Think of them like a seatbelt. They won't stop a crash, but they can help reduce its impact. So first, what is a buffered ETF? A buffered ETF is a standard equity ETF wrapped inside an option strategy that defines both downside buffer and an upside cap for a 12-month period. So let's talk about the buffer first. That absorbs the first slice of losses, 5, 10, 15%, cushioning mild downturns. The cap, that limits gains above a set threshold so you never capture the full market rally. So what does this mean in plain English? The fund takes the hit for the first fender bender on your portfolio, but won't shield you from the pileup, nor let you floor the gas when the market surges. Here are some must-know details. Upfront clarity. Buffer, cap, and reset dates are disclosed before you buy. Annual reset. Each outcome period lasts 12 months. At expiration, new guardrails kick in automatically. Embedded cost. The option protection shows up as lower cap rates rather than extra fees. ETF liquidity. Trades settle like an ETF, use simple 1099s, and carry no surrender charges. So why buffer ETFs are trending right now, and especially over the last 3 years? Assets in defined outcome ETFs have nearly tripled from $20 billion in 2022 to $41 billion in 2024 to $59 billion as of the end of June of 2025. So clearly, retirees want a front row ticket to markets' upside thrills, just with guardrails so they don't end up skidding off the fast lane into the ditch when momentum hits a slick patch. So here are key benefit driving adoption. Predictable outcomes. You know the exact risk-reward parameters before you invest. Transparent pricing. Option hedges costs are built into the cap rate and the ETF fees. There's no hidden fees. Flexible access. Intraday trading and no lockups keep the cash available. There's wide choices. There's over 300 different series that cover major indexes and even popular sectors. And there's a behavioral advantage. Clearly defined rules help curb emotional trading. So what buffer ETFs are not? They reduce but don't eliminate risk and offer no guaranteed income. Here are many of the caveats. Some trade-offs first. Bigger buffer costs you more upside. In a strong bull market, you'll lag the index. Time sensitivity. Buying or selling mid-period can alter your actual buffer and your cap. The tax nuances. In taxable or IRA accounts, realized gains are taxable and option income may be non-qualified. So who they suit? Buffered ETFs occupy a middle lane between stocks and cash and bonds. They may suit sequence-sensitive retirees, those in early retirement who fear a big market drop but still need equity growth. Liquidity-minded savers, investors needing downside cushion without annuity lockups or surrender charges. Do-it-yourself allocators, hands-on investors who prefer preset guardrails over stop-loss orders or market timing. But before buying, start with an honest self-assessment. Then bring sharper, data-driven questions to your advisor. Ask yourself, how much of a single year decline, 5%, 10%, 15%, can I tolerate before I lose sleep? If the market rallies, am I okay with gains stopping out at a cap rate? Will I need this money before the 12-month reset? And can taxes or required minimum distributions in your IRA account undercut the benefit? Ask your advisor some similar questions. How did similar ETFs perform in the 2020s drop or the 2022 bear market? Which buffer cap pairing best matches my income and my growth goals? What are the total costs, including optional drag as well as fund expenses? And what types of accounts minimize the taxes and the paperwork best? Here's the bottom line. Buffered ETFs aren't a silver bullet, but they can act as a seatbelt, mitigating the jolt of market swings while keeping you in the equity driver's seat. Used alongside a diversified portfolio of equities, bonds, and maybe other guaranteed income sources, they can add a layer of risk management to your retirement toolbox. Follow along for any more tips.